So if you have your, everyone take a seat. Okay, good morning. Today is May the 2nd. This is the Budget and Finance Committee meeting for Recreation Centers of Sun City West. My name is Dick Rhodes. I'm the chairman of the committee, and I'm going to call this meeting to order. So if you would please stand, and we'll pledge allegiance to the flag. Thank you. We have a quorum. The meeting is officially convened at 9:02. We have the minutes of the meeting from April the 18th have been posted, and do we have any conversation at all on that? And if not, I move that they be approved. So much. Okay. We're going to, we have a presentation this morning from CapTrust, and I'm going to ask Cliff Swan if he would introduce our speakers for us, please.
Good morning, everyone. We have CapTrust here. They're our financial advisors for our reserve fund, and we've got Nate and Carol here. They've been managing the plan since September of 2021. And they're here to present our quarterly performance.
Thank you, Cliff. Good morning, everyone. We'll start with just some general market commentary. Carol will cover performance of the portfolio, and we'll leave lots of time for questions. So just a review of markets to start. 2 data points on this page, looking at historical returns for 2022 with the solid bars. You can see pretty much everything was down in 2022. We've had a nice rebound in 2023. All equity markets are positive. Importantly for this portfolio, the bond market is up about 3% for the quarter. We'll explain why that is. And the only negative being commodities, which the reserve fund has no exposure to. So far, 2023 is off to a good start on a relative basis. I mentioned the bond market. We have some additional data here on different maturities of bonds, and part of what's driving performance so far this year is that you've seen a decrease in interest rates everywhere except for the shortest end at the 3-month level. So interest rates coming down is a tailwind for the bond positions in the portfolio, and that's helped returns so far in the first quarter. Just cover our headwinds and tailwinds from an economy standpoint. So the Federal Reserve does continue to act in the current environment. We expect this week that they'll announce another quarter-point interest rate hike. What we've seen from the market, as I showed on that last page, is that really affects only the very front end of the yield curve, and long-term interest rates seem to be anchored around 3.5%. So we don't think that decision will do much to the portfolio other than the very shortest term positions we have. The yield will actually go up, so that'll be a positive. But that does create some concerns within the economy and markets in general with, the idea behind raising interest rates is you're slowing growth. Their intent is to slow inflation, and that can have longer term impacts. So that's one headwind. You see financial system in turmoil. We see more of that this week with another bank that's been acquired with First Republic. And I think we're going to continue to see some challenges within the banking sector. That's also not great for the economy. Deposits are consolidating to the big banks, and that means some of the smaller banks that do a lot of lending in local communities are going to do less of that. So that's a headwind again for the economy as well. There was concern coming into this quarter that you'd see slowdown among corporate earnings. That actually hasn't been the case. Corporate earnings have remained quite robust, and so we'll see if it starts to slow down in the second quarter. But so far, everything looks fairly positive from a corporate earnings standpoint. And then the debt ceiling, which I think today Janet Yellen, the Treasury Secretary, came out and said the government will run out of money June 1st. So we have a pretty hard deadline there for that. It's an easy fix, unfortunately a political one. Hopefully it doesn't come down to the last minute, but it might. But we expect that that'll be resolved in time for the government to continue to pay interest on their debt. From a tailwind standpoint, we do see inflation easing. The last monthly number was at about 5%. If you recall, last year we hit a peak of 9.1%. So things are moving in the right direction. That's good all around. The labor market continues to be very strong, low unemployment levels, and consumers continue to spend. And the fact that you've got higher interest rates means for the first time in a long time that you are earning interest on savings that you weren't before, and your fixed income part of your portfolio has a higher yield and higher return expectations. So, I think this year you'll continue to see some volatility in markets as things work themselves out, but generally we feel good about the portfolio and where things are and what we see coming. Turn it over to Carol.
Good morning. I'll go over portfolio performance, and bear in mind this is from March 31st, okay? Get to some numbers here. Okay. Market values and cash flow. So we are current quarter as well as 2023 year to date. See if I can get this little red thing. Positive net investment return, almost 1,944,000. And we'll talk about the drivers to some of the return on the portfolio in a moment. A lot of it having to do with the portfolio is, as we know, 90% fixed income. And Nathan had just illustrated how we have seen a drop in interest rates on March 31st. And so that does give tailwinds to many of the fixed income or bond asset classes within the portfolio. On this page, we're still within the mandates of the investment policy statement. So very close to our targets there. We've got our almost 90% fixed income, 10% equities, and very close to our targets within there. Portfolio diversified across several different types of securities. You have a 20% threshold, and we're within the scope of that, as well as many different types of asset classes within fixed income. And then we also have our equity allocation and our broken out within U.S. equities and our international equities, again, diversified across different securities and asset allocations. We'll focus here on this page, just total portfolio calendar performance, 2022. I don't think we need to focus on the nowhere to hide year. But yes, we are seeing some headwinds this year in many different assets within the portfolio. Total portfolio performance, 3.10%, just for the first quarter. This is benchmark against a benchmark that is on page 24, basically a broad bond index, the ag broad equity index, as well as a broad international index as well, excluding the U.S., and we just weight it. So underperforming the benchmark just for this quarter, and it's explainable by the fixed income piece, which we'll look at the drivers here in just a moment of that performance. So lots of numbers on here, and you'll see just the fixed income component here. Total fixed income, the portfolio performed 2.68%. And looking at the aggregate bond index, which is what we benchmark it against, is 2.96%. So slightly underperforming. As we mentioned, it's positive performance this quarter because interest rates across the curve came down at this point in time. There was the more sensitive interest rates on the longer end of the curve came down, and this portfolio, as we are in a rising interest rate environment, we are tilted towards less sensitive instruments. So just for the quarter, underperformed. And we'll see going forward. We do expect the Federal Reserve to continue to increase interest rates, so it makes sense to us to have the portfolio allocated as it is. We have our U.S. equity returns here, slightly underperforming the Russell 3000 Very Broad Index. The drivers there for the underperforming of this is simply just an allocation to small cap and value index. And the beauty of having a diversified portfolio is here we see in our international equities, we're about 7.29%. And then with this one, we are overperforming the index. And just a reminder that the portfolio 1 quarter underperformance, overperformance is not a concern. We're mandated over a full cycle of 3 to 5 years. So total performance, they're back again to 3.10% for the quarter against the benchmark. I looked at the portfolio yesterday and we were at 3.7%, which is nice. So we're still continuing to see positive returns and recoveries in asset classes as of now. Yeah, I think that's, unless you have any questions for me specifically, I think I'll turn it over to Nathan for a Q&A.
Okay, so if you're ready for the Q&A, I would like to make a kind of a disclaimer, or at least some comments. CapTrust we do have a policy, financial, it's the investment of association funds, that's FI 12, that is very prescriptive, and it defines the parameters that we expect our investment advisory firm to stay within. And I guess the highlight on that would be a 90-10, 90% bond and 10% equity. So at that, I'm going to open questioning up for the committee, and then after that, we'll ask for questions or comments from the audience. So does anyone on the committee have a question for Nathan or Carol? Okay, Christine?
Nathan, Carol, well, more Nathan, but for either of you, you touched on some of the risks, right, the headwinds. Can you comment at all? I know we've had some past questions here and in other meetings about how, or if you're helping us manage through some of those risks that are out there. You don't have a crystal ball. I think we all understand that, but can you speak just a few minutes about how you're handling or managing that risk on our behalf, if at all?
Yeah, so I would say part of what drove underperformance this quarter was being shorter duration. And what really impacted last year was the change in interest rates that happened so abruptly. We went from 0% to 4.25%. I can show you on this slide. I go back. Sorry. The biggest impact was the 10-year Treasury rate going from 2.34 to 3.47. So that was the biggest impact to overall performance. And we have less long-term interest rate risk in the portfolio right now. So that's part of how we're managing that. I think, if rates do continue to rise, as I said, they seem to be only rising at the shortest end. So we're shorter to benefit from the increase in yield. But if they do rise in the long end, we're defensive against that risk. From an equity standpoint, which is at 10% of the portfolio, we do have some international exposure. So if you do start to see corporate earnings headwinds, international should do better, and it's done better so far this year. So that exposure helps as well. And just general diversification. So having some equity exposure, we think will be a benefit in the long run.
Are we at all? I don't see it. Are we at all? Do you feel that we're at all exposed due to either the debt ceiling litigation, which is completely out of all of our hands, right? Does that impact us? And also the instability in some of the regional bank markets. Are we exposed and maybe explain a little bit about that?
The truth is that everybody's exposed to the debt ceiling.
Are we more exposed than anyone else?
No.
Because we're all feeling it.
Yeah,
but,
if that doesn't pass, it's chaos in markets broadly. And
right.
Congress knows that. So I think it will be a political battle until it's a necessity that they pass the debt ceiling. So unfortunately, that just means volatility. It creates distrust in our political system. It's just not a good outcome. But I don't think you'll see problems within markets beyond just lots of up and down. The banking sector is a real risk. Ultimately, again, the government, the FDIC, they don't want the general public to lose confidence in the safety of their money. So they'll take the steps they need to ensure that everybody feels like my money is safe in whatever bank it's in. First Republic, just to get into some of the details, the banking industry actually tried to help a number of the larger banks put deposits in First Republic to make them more secure, and it didn't really matter. People pulled their money anyway and went to a different bank. And so ultimately, that bank had to be acquired by JP Morgan. So I think the outcome of what's happening in the banking sector is that you're just going to get consolidation, more banks getting acquired. That's more a bad thing for the economy, not necessarily as an investor. If you're an investor in a regional bank, yeah, that's not good. But we don't have individual stock positions, and to the extent there's exposure to regional banks and the mutual funds, it's de minimis, and it wouldn't, we're much more impacted by the broader market movement than any individual bank stock.
Thank you.
Yep.
Mr. Magnato?
Thank you, Dick. Can we go back to slide 3, please? Right.
This one?
I'm sorry, yeah, that one. For the benefit of the people who will watch this on video later, it's important that I think that the community notes that what goes down will eventually come back up, and this is evidence that we're at least on a little bit of an upswing. And that's important because a lot of people in the community, and I hear the chatter, are very concerned about this $4 million unrealized loss, and there are people who think we will never see that money again, and well, it may take a while, but we'll get there. So I know that we invest for the long term. On the next slide, I have a more detailed question, if we could. And so I noticed that on the right side, fixed income, treasury yields 1 year and 10-year have fallen just a little bit from where they were at the end of last year. Can you explain why and how that affects our portfolio? Please.
Yeah. So if you watch the 10-year treasury every day like I do, and you probably don't, it moves around a fair amount. And so a lot of people use the 10-year treasury as an indicator of the future economy. And so it's reflecting the belief that either when it moves up, it's reflecting that inflation will continue to be persistent, that growth will be positive, and interest rates will continue to move in that direction. When it moves down, it's a belief that the economy is going to slow and that the Fed in the near term is going to be cutting interest rates. And so, the move down at the beginning of this year between 12/31 and 3/31, and I believe even within this quarter, it got back up to 360, 370 before ending the quarter at 347, is a reflection of what's gone on in the banking sector. A belief that that is going to slow the economy and ultimately lead to the Federal Reserve having to cut interest rates to stimulate the economy again. Interest rates coming down when you have a lot of fixed income exposure is a tailwind. So that means the value of your bonds will go up as a result. And it's a good thing if you're an existing bondholder. Long term, lower interest rates is lower yield, lower returns. So there's a balance there. I think, we would like to see rates stable. I don't think we're going to see the short end at 5.25 for a long time. But I would bet, barring a major catastrophe, that the 10-year stays close to where it is right now for a while and fluctuates in that 3.5% to 4%. So my hope is that the recovery that we see will come a lot through the income and a little bit through the price movement.
Mr. Hobalt?
Thank you. A preamble to this. My intentions with what my questions will be are not to open an extended debate or conversation in this forum. but there is we've been asked as a committee by some owner members, as well as maybe offline, some of us have encountered folks, and a question comes up that I'd like to pose to you and get the benefit of your insights into this, not only for us, but for everybody in the community that chooses to listen in and gain this. It has to do with the investments in the fixed income portion, 90% of our funding, or of our reserves. You've had choices as professionals of how to invest that. We've turned that over to professionals. Logically, you're in a much better position than we as laymen are to make those individual security choices. We are invested heavily in mutual funds, maybe some ETFs, which represent a broad range of fixed income securities, and they are backed by bonds and fixed income. They're not equities. I understand that. But you made choices as opposed to invest in those types of securities as opposed to buying individual bonds, specifically government treasuries that would mature and give us our initial principal back. And of course, those funds that we have in reserve, we're not likely to spend much of that in the next few years. So you could argue we could outlast the markets and hold on to maturity. So there's a pro and a con there between funds and individual securities, which bear virtually no risk of capital. They have to be the ultimate of capital preservation, at least in my mind. So could you give us insights into how you have chosen the pros and cons of the benefits that you've chosen versus that other kind of strategy? There's a lot of questions within the community, and it's not well understood. And this maybe is a good chance for you to explain to us some of those pros and cons. I know when I get asked that, I don't feel like I'm equipped to answer for the decisions that you folks have made with your insights. Thank you.
Yeah, and we've heard some of this question as well in other forms, and I think the heart of the question is, well, why not a bond ladder, individual bond ladder, as opposed to funds or ETFs? So I think it helps to illustrate what a bond ladder would be. The idea of a ladder is to say, if I have, let's say we have $30 million, we're going to invest in bonds that have a laddered maturity. So some that mature in a year, 2 years, 3 years, 4 years, 5 years, and you can pick your term of ladder. But ultimately the concept is, as my 1-year bond matures, I'm going to go out, let's say it's a 10-year ladder, I'm going to buy a new 10-year bond and just keep that rotation of bonds moving. With $30 million, the average bond price, if you're going to buy directly on the market, you can buy them in typically $100,000 increments. So you have some limitations. If you're going to do 10 years, you've basically got $3 million per annual maturity, and you could buy a number of bonds at each maturity. One of the challenges with a bond ladder is, as you get interest income, you don't typically have enough to reinvest that at the moment. And I think to your point, John, this is a long-term investment, and you wouldn't want to just let maturing securities or cash flow sit and wait if you didn't have use for it. So it's not that efficient. There's also pricing challenges. So when you're an individual or even an organization like us and you're going out to market to buy bonds, there's a spread that you pay to a dealer, and that can eat into the profitability of it. So it's frankly more expensive to do a bond ladder than to use a fund. We have a slide we can bring up, but all of these ETFs and mutual funds are in and of themselves ladders. They own the exact same securities that you would own if you built your own bond ladder. They just own a lot more of them. But we can show you that they have maturities from 1 to 3 years, 3 to 5 years, 5 to 7 years, 7 to 10 years. They are doing the exact same thing. They're doing it more efficiently. They can take interest income on a multi-hundred million dollar portfolio and buy new bonds immediately. They can respond to changes in the interest rate market immediately, and ultimately deliver, we think, better performance for much less cost, 2-3 basis points in many of these funds. So, from our perspective, while there is a psychological benefit of owning a bond that you can see and recognize that when interest rates move, it's lost value, but if I hold it until maturity, I'll get all my money back. It's really just what I said, a psychological benefit. The bond managers are looking to maximize performance and return in the portfolio, just the same as you would be, but they're able to do it in a much more efficient manner. I think, so yeah, we'll bring up the slide, but so I'll just show one of these. So I don't think you have this, but as an example, this is the iShares aggregate bond ETF, and you can see 20% of the portfolio is in 1 to 3 year maturity, 13% in 3 to 5, 10% in 5 to 7, 9% 7 to 10, and so on. So we have a bond ladder here. As new bonds mature, if interest rates have gone up, they can buy a longer dated security. But we have an inverted yield curve, so there's a reason you're more concentrated on the short end. A bond manager is looking at the portfolio saying, if my 1 to 3 year matures, I have a bond that matures, I can go out and buy a 10-year that's paying 3.5, or I can buy a 1 year that's paying 5. So they are more actively managing this portfolio for your benefit, for all investors' benefit. And the other thing I'll say is, again, while there's a behavioral benefit of knowing that the position will mature and you'll get your par value back, it would price the same. It's the same holdings. So if we held individual bonds, we would come to you with the same performance information. It wouldn't be any different. You would have been down, 10% in 2022, just the same as you were holding the funds, because the bonds moved based on the price of the market. You would just be able to look at those bonds and say, well, that one matures in 2027. So if I hold it until then, I'll get all my money back. I would argue that I think the funds will outperform that holding because they can be more active in the current market, take advantage of changes in interest rates, and optimize the return for investors. So, ultimately we can do, we're doing what we think is best for the portfolio, for the committee, but, we do have individual bond ladders, typically in municipal bonds for individual clients from a tax standpoint, because you can concentrate exposure in your state of residence. Other than that, we use funds for everybody. It's more efficient.
A follow-up. Thank you for that. This is sort of a test. I'm going to try to feed some of that back to you, and I want to make sure that we all have a good understanding of everything you've tried to teach us here. The bond fund managers are faced with the same requirement to mark to market with that portfolio. Those bonds are held to maturity. They come due. We don't see it. It's all being done below the waterline, so to speak. But they are doing the same mark to market as we would be doing if we were holding treasuries. We would still be faced with the same accounting requirements, and our perceived on paper unrealized losses would be approximately the same, except for the benefits that you've mentioned about the more active management going on inside there. I'm trying to say this back in maybe a little more layman's terms, because it does cause a lot of confusion in the community. It's a lot of money, and it's not our money. It's everybody's money, and it's really important that people have a sense of security, no different than the banking news that's flying around now. It can be unsettling to people. So I appreciate you taking the time, and I just like one comment. Are my comments accurate?
Yes. And I would add too, we talk about building a bond ladder with treasuries, but you get paid a premium for owning corporate bonds or mortgage-backed securities, which if you were to build your own bond ladder, it would be very difficult to get the kind of diversification that you're getting from the funds on your own. You would really probably only own treasuries. So you give up return for the sake of, again, the image of safety and something that I can hold to maturity.
Thank you. No further questions.
Dr. Brown?
Thank you, Nathan and Carol, for your presentation this morning. Just for the benefit of the audience and also our committee, how often do you take a look at our holdings and make any changes? I know there are safeguards in place to keep that 90-10 or thereabouts, but how often do you actually buy, sell, whatever in there? What's your process for us?
There's multiple levels of review that go on an ongoing basis. Carol and I look at the portfolio on a regular basis from a philosophical or I should say a strategic standpoint. CapTrust has a 90-person investment group that is looking at markets, having conversations on a daily, weekly basis, and determining if adjustments should be made to the long-term allocations. We are not tactical investors from the standpoint of, every little thing that happens, we think we can get right and time perfectly. And frankly, I would tell you, if you look at the academic research, nobody's really good at that. You have a lot of decision points when you do that. So if you said, I think the Federal Reserve is going to raise interest rates, so I'm going to, make massive moves in my portfolio, and then they're going to cut it 6 months later, whatever it might be, decision to get in, to get out, when to make those changes. We tend to focus more on the longer term trends. So, the changes that we've made, we're getting shorter duration, we're, adjustments within our equity. We reduced some exposures that we had there. I imagine looking forward, if interest rates start to normalize, we'll look at extending duration a little bit more, but these are not, 3-month moves, 6 months moves. These are intended to be more longer term. And that's really, I think, for your benefit. The best portfolios have a strategy, they stick to it. They make adjustments when it's appropriate, but constant trading and trying to outguess the market, it just doesn't work out well.
Dr. Miller?
Thank you very much for your presentation. We went to the trouble of hiring professionals, and I think you guys are doing a good job. I've been an investor for a very long time, and early I became associated with a fiduciary that I worked with, and your comment about not trying to time the market and do all that. I realize people get uncomfortable when they see substantial unrealized losses, but they're just that. They're unrealized losses. They're not like you sold something at a loss that we're never going to recover. I think the message that I would like to make sure that people understand is, you have to, as you said, set a portfolio strategy, and you have to stay the course unless there is some substantial reason to change your strategy. And I haven't heard you say anything this morning that would make me think that you believe our strategy that we currently have in place is incorrect. Is that right?
That's correct.
Okay. So I think, we just need to stay the course, not panic. John, I believe, made the comment that we don't dip into these funds very often. And the reality is we have plenty of time to recover those unrealized losses. It's not like we're going to go spend $20 million next week, and as a consequence of that, we're going to have to sell things that we would take a loss on.
Right.
So again, I would just congratulate you guys. I think, we picked a good partner to work with, and I think you guys are doing a good job.
Yeah, I think the best takeaway from that is, let markets work for you. Over time, markets go up, all of them. You just have to give it time, and keep in mind, 2022 for fixed income was an unprecedented, once-in-a-lifetime type event. It will not happen again. I would not expect it to happen again in our lifetime. And the confluence of factors that contributed to that, very unique. So most of the time, this portfolio would have worst case 1% to 2% losses in any one year, and that would be very infrequent.
Mr. Bosak?
I was going to kind of go down the path that Ann did, and I would just like to remind people, especially those listening, not in the audience, Ann and her team put you and others through an exhaustive evaluation process with a unbiased rating mechanism to come up with the best possible candidate to do this work for us. You won that. So there was something they saw in you and your company that others didn't exhibit. The first year was kind of a learner for you. The second year, we all took bullets in the forehead. And now you're starting to talk about things going the right direction. And the worst thing we can do, I think, is try to manage you. That's your business. That's your job. All our responsibility is to make sure that you're doing it in the best possible way based on the limited amount of knowledge we have about your world that you work in. And I think we've met that obligation. You survived some very heavy questioning at the last appearance here, and I apologize for that, for the group. It was unnecessary and uncalled for. I don't think there's anybody on this committee who would question the decision to employ you. We're pleased with what you did. You're always professional in the way you present things. I have total confidence in what you're doing, and I second David's recommendation as well. Thank you.
Thank you.
I have one question for you, and it's very hypothetical. And let's just pretend that we have an opportunity to second guess ourselves from 3 years ago when we decided to do a 90-10, and let's just say we went to a 70-30. What do you believe would have happened? What do you believe our market position would have been?
So within the context of what happened in 2022 with markets, equities were down 14 to 20%, depending on the region of the world. Bonds were down 13%. You would have been worse off, probably 3 to 4% worse off. And, you know, I think it's too soon this year to tell. But basically what you expect with a more aggressive portfolio is a higher long-term return, but a lot more volatility on the way there. So, you know, you'd probably be still lower than you are today. 5-10 years from now, you'd have a higher average performance number, but you wouldn't have felt good getting there. And I know from the process we went through with Ann and enough conversations with Pete and with Cliff that COVID, the experience during COVID was more risk than the portfolio or the committee or the organization was comfortable with. So if you hadn't made a change then, you would probably make a change, a bad one, sometime in the near term when markets were more volatile again.
Thank you. Actually, I think that all our committee has exhausted their questions, so now I'd like to open this up. If there's anyone in the audience that has a comment or a question for our presenters, this would be the time to do it. As you come to the podium, if you would identify yourself with your owner number, please.
Hello, name is Kerry Shimoleski, 120-865. And my question was, I'm sorry if I missed it. My mind's trying to digest all those slides and trying to listen at the same time, but I didn't hear much about taxes. Okay, so I don't know how the rec center is taxed, and that's part of the investment returns. You know, I give my broker $10 and he says, hey, I made $1 for you this year, 10%. But then my accountant comes to me later in the year and says, you owe me a quarter.
Yeah.
So I call my broker and I say, well, I need a quarter out of my investment so I can pay the government.
Yeah.
So maybe just give an overview how we're taxed, and I assume, from the little I know, 2022 was a very good year to take losses. I mean, it was like a no-brainer, right? I mean,
Yeah.
So, you know, did we accumulate a lot of losses that we can use in the future? So generally speaking, maybe some comment about, you know, taxes as it affects our investment return. Thank you.
Yeah, and I'll speak on behalf of the organization, and I expect Cliff or Pete will correct me if I'm wrong, but the organization is a nonprofit entity, so it does not pay tax on investment returns. So taxes are not part of the objective of the portfolio like it would be for you or or a business. So we have the luxury, I guess, of investing without worrying about taxes. In 2022, we could have taken losses, but they wouldn't have been any value like they would be for you, as an example. Go ahead. Yeah, effectively, yeah. It makes our job easier in some ways because we don't have to think about taxes when we make adjustments to the portfolio. Whereas in your example, you might have gone back to your broker and said, why did you realize gains? Now I have to pay tax and I didn't want to pay tax. So thank you.
Do we have anyone else in the audience that would like to speak? Okay, thank you very much.
Thank you.
I want to, before you leave, I want to thank you and Carol for your attention, your professional presentation. Been a very nice job for us. We're going to move on to item 3.02 in the on the agenda. We're going to have a financial review by Mr. Swan.
Thank you, Director Rhodes. Good morning, everyone. Again. I can't believe it's May 2nd already. This year has just flown by. But here to present the March year-to-date financials and then do a quick update on the budget. No presentation, just a couple of things to talk about after that. So let's get right into it. So for March, for the month of March versus last year in revenue, we were favorable by $144,000. Golf revenues, although rounds were down, stayed steady, thankfully. Year over year, we did have a favorable $15,000 in golf. And looking at our expenses, some of those impacts to our health insurance costs and increase in minimum wage, unbudgeted, higher amounts are affecting our year-to-date to budget, or excuse me, March and year-to-date, but $132,000 unfavorable for March actual versus budget. So overall favorable, $12,000 operating cash inflow to budget with those two categories. Looking at year-to-date, $391,000 favorable, $34,000 favorable in golf, $103,000 in ancillary. That's all the golf cart rentals, anything rental, and then as well as our cell towers. That's what's in that revenue bucket. And we're favorable $103,000 for the year. And then events coming in really strong at $115,000 favorable. Casey and her team worked hard this year at providing events, and it's been a good thing for us this year. And then year-to-date, $407,000 unfavorable. Again, $145,000 wages and taxes. Wages, benefits, and taxes really impacting us. And then on the maintenance side, supplies, repairs, and landscape, inflation really impacting us. So pretty much right on budget for the year, $16,000 unfavorable. We anticipate the rest of the year to roll out on budget, but $16,000 unfavorable through March. Looking at some of the changes year over year, again, most of this was foreseen, but and budgeted the $1.2 million over prior year in wages and taxes. Made some great strides in our pay scales and structures. Still have a little bit of work to do there in certain areas within the association, but made some good headway this year. Of course, being shown in year over year expense. And then again, repairs and maintenance coming in $232,000 over last year, and then supplies $137,000. Looking at the capital section, a couple of things to pay attention to here is APF fees. Still running behind budget on that. We anticipated that, and we anticipated that in the budget for next year as well. But 144,000 unfavorable versus versus budget. And then one thing to point out is in the investment, unrealized gains and losses, favorable 615,000, which helped get us closer to even for the year. And happy to report April pulled that even year to date on the investment change. So, but APFs compared to budget were $500,000 behind last year. What be in red? I'm sorry. Which slide are we on? Oh, sorry. Yeah. Yes, it should be black. Well, yes, it should be black. You're correct. Sorry, typo. Okay, you passed. I was seeing if anybody would get that. No. Okay, looking versus prior year, again, APS was just, last year was really an outlier when it came to APFs. However, this year we're certainly running below our 1,200 annual rate, tracking at about 1,000 this year, running $1 million behind last year, and then the change in the market and valuation change they talked about earlier. Obviously, after what happened last year in the third quarter of 22, third quarter of 21 and first quarter of 22 is showing here the favorable over prior year and the investment change. So, the good story here is the reserve fund valuation change, which is good. The investment income is up 187,000, which is very positive, and hopefully we'll continue to see that trend as the interest rates cool down a little bit. Overall, looking at the revenues over under expenses for budget, we're unfavorable 560,000, mainly due to those APF changes that we talked about. Taking a look at prior year, $1.5 million in operating and favorable 763 for total unfavorable 793. Taking a look at the capital budget, roughly 11 million in capital budget. We're projecting to be right on budget with a little bit of projected favorable variance of 15,000. Most of the capital spend has been PO'd, 10.5 million, and the highlighted items are items that are completed and paid for. So working down through the budget. One of the things that we're strategizing on now is with CapTrust is making sure that there are funds available when it comes to November, December, after we get our annual audit financial statements, and making sure that the funds are sitting in the most efficient way for us to pull to encumber the rest of the Deer Valley project, essentially. So looking at the allowances, 400,000 in allowances. We have unspent allowances of 167,000. Whatever gets unspent in this area, it doesn't get pulled forward or encumbered. That goes right back into the reserve fund. So any of the unspent allowances get put in the reserve fund, and then this is a detail on what we've spent those funds for. Important to point out that some of these items, such as the library storage container, the ARC storage area, these projects were funded by those clubs. So that's always good. So taking a look at the reserve fund, we're right on, pretty much right on budget, 49% versus 50%. We'll see what happens in the investment change as we finish out the year, but pretty much right on budget with all the impacts that we talked about year to date. And that's it for March, the March presentation. Mr. Rhodes?
Do you have any questions from the committee? Director Brown?
Are we seeing any improvement going forward in April with the APFs? I know there's a lot of houses on the market right now, but I talked to some people yesterday who said they've had 3 neighbors moving over here from the Grand.
Okay.
So I'm wondering.
So yeah, we kind of rallied a little bit at the end of April. I think we ended up 116 or 118 for the month. That's down from, I think we were about 190 last April, but more of a typical number for us for April. It's still a little behind, but yeah, no, we're seeing it. And then the inquiries in May are coming in, and they're looking good. So we'll see how we finish out the year. You're welcome.
Bosak?
Cliff, I got a logistical question. I'm afraid I already know the answer to this, but I'm going to approach it backwards. If the goal was to have the previous month's financials printed in the Rec Center News rather than 2 months prior, so that everything that someone was looking at was much more current, what would have to happen? Katie's world, right?
Yeah, the timing of when she posts that, unfortunately, isn't conducive to having 1 month back.
So you don't, how long does it take you to get a month closed? 2 weeks?
So I would say, yeah, we close anywhere for around the 15th of the following month.
Yeah.
Is when we get the month closed.
And I know she needs the information before that, but it just strikes me as kind of Neanderthal to getting the March or the April Rec Center News the last week of the month and seeing February results.
Yes.
Especially in a period of time where we really want members to be engaged with where we are financially and kind of positions we're fighting. Just a thought, questions.
Okay.
Brown?
Piggybacking on what Gary just said, perhaps we need to have something put in there when you put the financials in, like you just had February, and in bold, maybe large letters at the bottom, for updated financials go to, and direct them to the website and the address.
Yeah, so when we present the financials here, we post them. So yes, you're correct. I understand what you're saying. Yes, we could do that. We can do that. Oh.
Mr. Hobald?
Thank you. If we could dial back to the income from operations March year-to-date, I just did a little quick math here. I took the $16,000 variance, and you could use expenses, you could use revenue, but that comes out to about 1.1%. Accurate with that statement?
Yes.
Okay. I'd like to remind everybody on this committee, anybody from the owner members that are watching us and the governing board, that as we go into next year and there is thoughts about indexing and so forth, I would like to point out the extreme level of accuracy we have historically had in our budgets, including this year. So if you are looking for a good predictor of the amount of revenue we need to raise to pay our bills, look first at the budget. It is by far the most thought through, carefully vetted document I can think of to base future decisions on. There I've said my piece. Thank you.
Mr. Bignato?
John, I love you, but I'd like to remind everybody that at the close of the prior fiscal year, the amount of net revenue was way, way, way above the budget. And that includes an extra $1 million in golf revenue that was brought in that year that wasn't budgeted for. So it does work both ways. This, however, I certainly was just as pleased as John was when I saw that we were off by only $16,000. That's not even worth mentioning. So thank you.
Sometimes you're a hero, sometimes you're not.
Okay, do you have anything else for us?
No, I'm going to talk budget a little bit.
Okay.
So transitioning over to the budget, some feedback we received through our budget forums and through this committee is that the accessibility of the budget isn't for the layperson, maybe might not be very easy to find on the website. So one of the things we actually had a question from Ms. DeVello and requesting that be more visible on the website. So what we did is we got with the IT team, Katie and her team, and we posted down in the featured news section. We posted the budget, the proposed budget, and on there is a link to the updated budget packet, which is posted to this meeting as well. So to give more visibility to our owner members. And then as far as if someone would like a printed version of this and they don't have the ability to go online or whatever, we're going to make this accessible in our membership and as well as the library, be able to print out versions of this for people to review. And
Could you go over that trail again? I lost.
Sure. So you go to the home page, and then if you scroll down to the bottom, in addition, so let me also point out the fact that anything that's presented at any of these budget and finance committees and all that is all on board docs, and there's always the ability to go there and get more detailed, the budget presentation, the videos, things like that, to really drill into the presentations and the budget. However, the accessibility of the actual budget, we wanted to make that more accessible. And so if you go to the main page and scroll down to featured news, and then as the featured news, those will move down the line, you'll just click older entries and you'll be able to still access it. And then we also post that in the financials section. Typically we wait till the budget is approved and finalized before we do that, but we can also post a version of that in there for where we're at. I would say we don't want to do that necessarily until we get to the budget forums and post it, because it is accessible. It changes and evolves so much. We don't want to make it confusing either. So we'll continue to post on board docs, and then when it comes time to present to the community moving forward, we'll have it in the featured news page as well as the financials page. And the actual budget itself has been updated for March actual, and so the projection was updated. It didn't move much at all. So the current budget packet, the proposed 2023 financial is March actual versus and projected April, May, and June. And that'll be the last update that we do on the projection. At this point, we won't update it for April. We'll keep March will be the last update on the budget itself.
All right. We have any questions from the audience for Mr. Swan? Okay, thank you. Yeah, oh, I'm sorry, Mr. Busak?
Dick, or Cliff, I have a couple of questions from the financial report section, which you didn't cover.
Okay. Can you bring up the PowerPoint on the.
Three questions, actually. The first one, just the year-to-date through March P&L.
Oh, can you bring up the packet, the financial, the PDF? Okay.
Yeah, that one.
Okay.
I know the work that you guys go through to prepare the budget, so I'm not questioning the process or even the result, but when you look at that right-hand column and you see all those brackets on virtually every single item, significant dollars, obviously, we really have a challenge coming into next year. And the budget that you currently have together looks at improving all of those with, I think, one or two exceptions. Your level of confidence, I know, has to be very high. Otherwise, you wouldn't have printed it and you wouldn't have put it that way. So I'm not, it just makes me really nervous to see all those brackets from this year and knowing the recoup we have to do and then to build back upon to be successful with our plan next year.
Yes. Thank you for pointing that out. No, you're right. I mean, we've operationally, when we went to our management team, there were some anomalies that we had to take care of this year as well, operationally, and yeah, it's going to be a challenge. We're up for it, but yeah, it will be a challenge.
Okay. Page 7. Yes. The section on the top, maybe it's a misunderstanding of the word, but I see checking and sweep account. And it's $3 million this year. Last year was through June, $13 million. That's not sweeps from golf earnings that the clubs give Susan to be able to pay the, no. How does, it's just the numbers don't jive for me. What
so
changed?
In the past, I believe we had, this is before my time, but I believe we had sweep accounts, investment accounts that they would direct at the end of the night, money into those accounts and then sweep them out back into the checking account. Okay, so I believe that's where the sweeps comes from. The change year over year, the short-term operating cash investments, we looked at doing something similar, but there were a lot of pitfalls in there, and there were actually some policy things that were blocking us from doing that, and then the rate of return just wasn't there. So we decided to do the treasury bills and do those T-bill investments, short-term investments, and we put those in 1 month and 3 month increments, and so the money that's sitting, that 8 million, that's 8.5 roughly million that's sitting in the short-term operating cash investments was typically in the checking, or last year was in the checking and sweep accounts.
Yeah, I presume the two added together were going to butt up against the other, but I wasn't sure what was in there, so I appreciate that.
No, great question.
Lastly, on page 9, I'm embarrassed to say I don't know this, but it makes no sense to me, I guess. I understand these are the number of cards as we go through each month on a rolling basis. What's the members with no golf card? What's that all about?
Okay, so those, it's a little deceiving because it says members, but it really is member rate golf. So it includes tenants and associates and members. So it's the transaction type is a membership golf rate is what it is. So there's not 31,000 members per se. There's 31,000 contacts in that bucket. So it's not membership. It's not the 29,000 membership.
Is it transactions?
It includes, it's types of rounds. How do we say? I don't know. Yeah. Yeah. So it's how we charge the round of golf for the price level ID in the system, and those get the membership rate for golf. So those are the contacts that get membership rate in golf. So that's the total of those.
So it's something really important to you, but totally irrelevant for us.
Well, yeah. I mean, if you wanted to call it members, right, we could change that.
No, this,
Yeah.
I couldn't figure out what it meant, and I've seen it for years. And
Yeah,
I think
yeah.
maybe out of habit, we just keep using it, but I don't know what purpose it serves, that's all. Thanks for the answer.
Oh, you're welcome. I know it wasn't very good. Sorry.
Brignato?
Gary opened up the can of worms, perhaps. Can we go back to page 3?
In the packet?
On the bottom of the page where it says 3. I don't know, in the
Okay.
packet it's,
Financial statements.
yeah, this one. Keep going back
Okay.
or forward, whichever, that's the one.
Okay.
So down in the middle where it says expenses and then wages and benefits, and this jumped out at me earlier, and now I do want to ask the question. So wages and benefits were off by $1,249,000. It's a huge sum of money. And the reason is due to larger health insurance premium increase than budgeted. Was it truly $1,250,000 more, or is some of that wages that for whatever reason weren't budgeted for?
So some of that is wages, to answer your question. We budgeted, I think it was an 8% increase in minimum wage. So minimum wage is impacting that. It came
Sure.
in much higher. So that's the biggest impact. We did some position changes within the structure of our employees, and we took some people off. Their wages were tied to minimum wage, and we took those out and graded them like a regular part-time rate in the janitor area. We also did our starters at the golf course. Basically, anybody working on a register, we took them kind of out of that minimum wage and did increases in those areas. That wasn't budgeted for either. But the main impact of that is due to minimum wage coming in higher than what we had anticipated. And then also the health insurance coming in higher at 34% year over year. I think we budgeted 15% last year.
Put that in dollars, the health insurance premium. How much in dollars did it go up?
I'll have to get that back to you. I don't know off the top of my head, but I can get that for you.
All right, thanks.
Wasn't that on one of the slides for the budget forum?
Yeah, it was 250-ish thousand.
I was going to say 250.
Yeah, year over year. I thought you were one of the
So
unbudgeted
then we were off
portion
about
of
$1
that.
million just in wages. And because if it was 250,000 was the insurance premium increase, correct? Year over year?
Yes.
So then the rest of it, $1 million is wages, which are just killing this community. It's just killing us.
Yeah. The wages are. I mean, we're 65% of our overall expense structure. Yeah. Or the service industry, wages is by far our biggest expense.
Okay. Okay, we'll get to you in just one second. Okay. I'm going to ask for comments from the committee.
Dick, we just had questions on on 5.02. So the questions that both Gary and Frank were asking were on 5.02. Are our questions on the on the year-to-date results, or are you asking for questions on the budget?
I was just asking for committee comments because I thought we had already completed the discussion on the budget.
I don't know. I lost track because we bounced from one agenda item back to the previous.
Well, Cliff has maintained the podium and has talked about 2 items. Okay, so let's back up. Does anyone have questions that are
On anything.
unanswered for Cliff regarding either one of the 2 issues that he's been talking about? Okay. So, before we go to committee comments, let me ask for any comments from the audience. Does anyone have anything they'd wish to ask or any comments they'd like to make? This would be the time. If you'd please come to the podium and tell us your name and your rec number, please.
Good morning. My name is Bruce Lees, 135422. I appreciate the opportunity to come and speak today. I know the board has had many hard challenges in trying to muster the budget for this coming year. I did have the opportunity to look at the projection, the 5-year projection that was performed in 21-22 and compare it to what the expectations were for this year and how it affects the progress for the upcoming budget. But I did have a couple of questions that I needed that concern me that I would hope to get some answers to that maybe help me decipher how the budget is laid out. One of the concerns I had was how the rec center or the committee, budget committee, determines the number of residents in Sound City West to calculate the dues. Because when I run the numbers on the projections of the budget against the actual dues fees, I come up with a varying amount of persons.
Is that something you can answer, Cliff, or
Yes.
we're going to have to ask Mr. Schwinn to give us that?
I can answer
All
it.
right, thank you.
So when we're talking about member dues, so there's a category in the revenue section called membership,
Yes.
and that includes 10 or so different buckets of revenue. It includes our tenant fees and things like that, transfer fees when we sell properties, late fees, just guest fees, I believe are in there. So there's a bunch of different things that impact that line item. When we're talking about membership specifically, when we recognize our revenue, when you pay your dues, we recognize 1/12 of that every month. Okay? So when we implement a dues increase, we essentially get about 50% of the value of that dues increase year over year. So in that actual first year. So it's not as simple as just taking the dues increase and multiplying it by the number of residents.
Correct.
Because of how we recognize the revenue. And it's
Okay.
recognized on a 12-month cycle. So if your membership was due in July, but someone else's membership was due in March, we're going to recognize 3 months for that person. We're going to recognize 12 months for you. So
Okay, and I appreciate that clarification because I didn't know if there were other factors of monies besides just the dues, like you said, tenant activity cards and things like that.
Yeah.
So that helps me clear that up. One other question is, are the room and remodel rentals listed under special events in revenue?
No, those are listed under rec, I believe. In
Under
the
rec.
In the rec category.
Okay, okay. So they're not broken down individually, and if they're into rec, then that answers that question for me. Does the special event revenue come from sales of event and concert tickets?
Yes.
Okay, so,
Well, it's the net. So we book that. We don't book a gross revenue and then expense down in the expense section. We combine all that together. So in net, yes, it's there.
okay. Because in the budget meeting last week, it was indicated that there was going to be a $2 price increase in the ticket sales. And I'm assuming that that's going to be across the board for all events that are promoted?
Yes.
Okay, because there was a ticket increase last year far more than the $2. So how are you? Well, I just read what I wrote down. Why $2 price increase for tickets when the projected revenue is forecast to increase 20%?
So the $2, we sell roughly 30,000 tickets. So that's the revenue increase, should be around 60,000 on there.
Mm-hmm.
So that 60,000 increase results in whatever percentage year over year.
Okay, so basically you're looking to make up some revenue from another area to make up for another shortfall in some of the operating expenses?
So yeah, we have quite a few levers we can pull when it comes to revenue. We've even done recommended a fee increase for our guests,
Yes, I saw
adults,
that.
and so we have all these different areas that we can kind of touch on to try and help cover the increased costs.
Right, so we're gonna
Yeah.
nickel and dime in various different categories to hopefully reach some kind of mitigation of budget shortfall.
It's a budget. Yes.
Right, in other words, we're looking to derive money from one source to help compensate for a shortfall in another. Would that be accurate?
It's not a revenue question. It's a budget question.
Okay,
We're not for profit, so we look at all the different areas that we can spread to cover increased costs and to cover the budget and to bolster the reserve fund.
thank you.
Yes.
Looking at the, and I apologize for taking so much time. The FY 22-23 rec fee increase was 2.4% to 509. And according to the 5-year plan that was published in 2021, that was pretty much in line with what the projections were by the Budget Committee and subsequently the board, with expectations of rise between 2.3 and 2.8% over that 5-year term. I'm just curious how the board or the Budget and Finance Committee believed a 6.1 fee increase was necessary over possibly 3.1%.
I don't believe anybody anticipated 8-9% inflation rates
Correct.
back in 21. So when it is a projection. Once we get on the market, we look at the increased costs and we put a budget together.
We have spent the best part of the year going over our expenses for the community. We've heard presentations how our health insurance has risen 34% with another expected increase of an additional 15%. We know about grass seed that it's gone up 300%. Inflation. There's reason after reason after reason why we need to have an increase in our dues. We've gone through the diligence and examined all of these. Our APFs. We were hoping they would be 1,200. We looked at it and said, "There's no way it's not going to be 1,200.
Correct.
It's going to be closer to 1,000." That 1,000 times $5,000, and that's what they're proposed. That's a lot of money.
Yes.
$800,000. So, there's just to ask to why is it 6.1% instead of 2.8%? Because of inflation, because of health insurance, because of minimum wage. It goes on and on and on.
Right.
And we've literally spent almost a year going through that.
And I appreciate the hard work and diligence.
So
And
Yes.
if I may take the opportunity to continue for just a few
yeah,
moments.
yes, please.
So looking at all the pages of the proposed budget, then I get to the last page where it talks about rental fees for various facilities. I'm curious as to why the reduction of rental fees for the social hall and room rentals on at least half of the facilities that we're able to rent out. If we're looking to make up or at least maintain some kind of budgetary constraint, I'm looking for someone to possibly explain how we want to reduce those rates versus the rates that they currently are.
So one of the things that we need to keep in mind is that we're not looking to make up what you consider a shortfall. There's not a shortfall. This is revenue that's being generated that's for the interest and the well-being and to pay for the operation of the community.
Yes.
So when we look at things like room rental, when we look at things like ticket prices, we want to see value, but we also will welcome the revenue that we're going to generate from that. So the reason why we've raised it, it very well could be because of, we wanted the clubs to have a break on their fees when they rent things. I mean, we try to make it as equitable as possible, but I think that it's going to be difficult, if not impossible, to try to explain when we look at line items for this room and this room and this room, the individual things, because we look at that in toto. And it's all part of the package that we've put together.
Is it possible that lowering the rate will provide some more incentive to have that activity increase?
Well, anything is possible, you know, but in our best judgment, this is what we think we needed to do. Okay, I think we have time for one.
Thank you very much.
Thank you, sir.
No, I have just one more if you may.
Okay, thank you.
I just happened to get information this morning from a reliable source that indicated that currently Sun City West has moved 742 properties this year through the close of April. If the numbers project the 10 months that have occurred, we're looking at maybe 886 properties, not 1,014. That would probably affect your APF numbers.
You're absolutely right. And this committee, about 2 months ago, looked at that projection number, and we worked on that for probably 20 minutes, trying to come up with what we thought was a good projection. Is it right? I don't know. I'll know at the end of the year. But like all projections, this was our best answer that we could come up with.
Correct.
We know there's money associated with that. That's why we spend the time and the diligence on that.
Correct.
So you're absolutely right.
Thank you so much for your time.
Thank you. Mr. Bosak?
Let me thank you for your interest. You have taken the combined interest of the entire year's audience and surpassed it in one, and I thank you for your diligence, really. Two things, though. You questioned the 6.1%. The average increase in dues over the last 3 years is less than 2% per year. Less than 2% a year each of the last 3 years. So we're really behind the eight ball. We've lost a lot of steam over the last 3 years by not taking an aggressive approach, but riding the coattails of APF fees in golf. They've carried the community.
And I do understand that, and I still believe that it's the best bargain.
Good for you.
Thank
Second
you.
thing is, if this was your business and year-to-date through March, your revenue was down 0.1% and your expenses were up 10.3%, you'd be doing the same thing we are. So thanks again for your interest.
Thank you. Does anyone else in the audience have a question? Okay, thank you very much. I would like to go to committee comments. So could we start with Mr. Bosak? Yeah, Dr. Miller?
Cliff, you sat down too soon. Well, this is, I guess, more of a, answer from there. So what I thought going back to the gentleman's APF numbers, I thought what I heard was 733 through March. Was that correct?
Yeah, I think we put it on, it's on the presentation.
Yeah, it was on a slide. Now
Yeah.
I can't find it, but it was 733 through March, and then you said you thought it was 118.
Yeah.
So we're pushing 850 through the end of April.
About 1,000.
Not the number that you mentioned, sir. So.
Well, that amount came right off of our food, which also included non-market listing. And that's up close to April 30th.
Okay, well, I'll go by what Cliff's numbers are.
733 APS this
733
year.
plus
Yes.
118.
Yes, yes,
Okay,
sir.
Thank you. Do you have any other comments, Dr. Miller? Director Brown? Mr. Huwald?
No.
Mr. Bignato?
No.
Ms. Novello?
I just wanted to thank all the residents that came to those budget forums, right? They're the ones, although you attributed the suggestion to me to put that big, huge honking thank you link on our homepage so all of our members can go and quickly find the proposed budget. I really appreciate that. But I might have brought it up, but there were several people who commented about it. So thanks also to all the people who came to that. And thank you all for taking that suggestion. That'll do for today. Thank you.
I do want to also thank you very much. I believe that your questions personified many of the questions that our homeowners are asking us. And you were bold enough to stand up and ask those questions. So I really, I wish we had more people that would show up at our meetings and the town hall meetings that we have and ask that question. So thank you very much. It is 10:26, and I adjourn the meeting.